Welcome to The Bottom Line with John Harrison, your tour guide through all things financial. Build out your financial skill set with crucial knowledge and tactics and easy to follow answers to all your essential money questions. And now, your host, certified financial planner, ordained minister, multi-published author, and president of Aspire Financial Advisors, John Harrison.
Hello and welcome to The Bottom Line. I'm John F. Harrison, your host. And as you know, we deal with all things financial here. And in this episode, I want to take a step back, slow down a little bit, and walk you through some of the financial news and tell you how it's likely to impact your bottom line. The issue with most news is that there's such a tight schedule. They have to fly through the facts so quickly that they often can't take the time to give those facts any context, and thus the listener ends up not knowing how that fact affects them or what it really means. So we want to go through some of the things you've been hearing and talk about what they mean, what you will likely see in coming months. So we'll highlight the things that the media tends to skip, and they need to allocate so much time to sports news and celebrity gossip and things like that. So we're going to break down the business news, the finance news, tell you how it will affect your wallet, and then we will dive right into that as soon as we take care of a little financial business here. We will come back on the other side of this short break and jump into the news roundup in just a moment.
People say I've got a great smile. Well, I have to say, this is all thanks to the professional team at Beacon Dental Group right here in Dorchester, Massachusetts. I've got world-class dental care. Beacon Dental Group has expert and caring staff dedicated to providing the most advanced and satisfactory treatment in all aspects of oral health. Their services are designed to meet your needs and give you a perfect smile, too. General checkups, cosmetic surgery, Gemini laser service, and advanced procedures, all in a state-of-the-art facility. Call or visit Beacon Dental Group today, 1026 Blue Hill Avenue, Dorchester, Massachusetts, or call 617-282-2146 for a smile that lights the world.
Welcome back. We're talking about a financial news roundup, and I want to begin with the elephant in the room, and that is the Federal Reserve. There is a statistic that is due to come out on Wednesday, July the 12th. It will likely be in the very recent past as you were watching this, but on Wednesday, July the 12th, the inflation report will come out. And the reason that's important is because the Federal Reserve is going to use that report to decide what to do with interest rates. And what they do with interest rates affects just about everything, from the price you pay for borrowed money to whether or not your company ends up having layoffs, to any number of things. What they're trying to do, and we've discussed this topic before, what the Fed is trying to do is to manage the economy in between two extremes. One extreme is too much inflation, which we have been dealing with for the last couple of years. The other extreme would be a severe recession, which they are trying to avoid. They need to slow the economy to get inflation in check. They don't want to slow it so badly that it ends up creating a severe recession. The problem with it is that they can't tell what their actions have done until sometime after they've done them. There's a lag effect between a Fed action and the result of that action. So they're flying blind. They're trying to shoot a bullseye in the dark, and they're kind of stuck seeing after the fact how they did. So here's what I'm anticipating, and here's what you are very likely to see in terms of Fed action. They're going to be meeting at the end of this month. It's called the FOMC, the Fed Open Market Committee, and their meeting will end on July 26th, and on that date they will announce what they're going to do with interest rates. They have three choices. They can raise them, they can leave them where they are, or they can lower them. Almost every Fed observer And the Fed governors themselves who have commented recently anticipate that they are going to raise rates again on July 26th. And so we're probably looking at 25 basis points, i.e. 0.25%, in terms of the rate hike, and that would bring the federal funds rate to 5.5%. Why are they doing this? They're doing this because inflation is still not where they want it to be. Now, it's going to be interesting to see how the media spins the inflation report that comes out on Wednesday the 12th, because the consensus is that CPI, the Consumer Price Index, what you sometimes call headline inflation, it's what the media talks about, should be somewhere in the threes, 3.9, 3.8, somewhere in the threes, which is down from where it has been. The most recent look at it, I believe, was 4.6%. So if it's in the threes, the media will crow. They'll jump on that and say, see, things are going great. There's a bit of a catch in that the CPI is not the number the Federal Reserve will be looking at. They're going to be looking more at core inflation. They've said this multiple times. And core inflation is the CPI with housing and food stripped out. And so with the core numbers being a little on the sticky side, they're not in the 2% range that the Fed is trying to get them to. They're liable not to be satisfied, even if headline inflation comes out in the threes. It's not enough progress for them. It is very likely that they will, in fact, raise rates on the 26th. Now, every time they raise the rates, borrowed money gets more expensive. That's why it's so much harder to buy a house now than it was 3 years ago, because the current typical rate for a 30-year mortgage is about 7%. That means you can afford less house than you could a few years back. It means that people who are thinking of selling their house and getting a different one are thinking twice, because they don't want to give up their 2.8% mortgage and exchange it for a 7% mortgage on a new house. So it crimps housing supply. That's one of the reasons the housing prices have been so stubbornly high, is that there's not enough people selling yet. And it also crimps demand because people don't want to borrow money at the higher rates. But it's not just housing. If you're looking to finance a car, that's going to get more expensive when they raise the rates. If you carry a balance on a credit card, that's a variable interest rate product, that's going to get higher when they raise rates. It's one of the reasons we've been telling you for months, get those cards paid down, get them paid off, don't carry balances, because the interest, which is the cost of the borrowed money, is just going to get more and more onerous. So what the Fed is looking to do is to damage the economy, slow down the economy without damaging it too much. Consumer spending hasn't really slowed yet. They want it to slow. And the thing they're looking to dampen, to make it slow, is the job market. Unemployment is still very low. The economy created 209,000 new jobs last month. And so hiring is robust. The average wages of wage earners went up 4.4% year over year versus last month a year ago. Now, you may say, well, 4.4%, it didn't go up as much as inflation did, and you'd be right. The average person is still losing some purchasing power because inflation has increased faster than wages have. But they want wages to be flat. They want unemployment to be higher. They want to take the wage inflation out of the equation because they think that's what's driving core inflation. So they're looking to see a few more unemployed people. They're looking to see those unemployed people suddenly start spending fewer discretionary dollars because their economics are a little bit uncertain. And that's really the whole game. Try to take some of the steam out of the economy so that inflation doesn't run away, hopefully not drive us into too deep a recession. They're also looking to slow loan demand from the bank side. They have proposed a rule. It has not passed yet, but they are considering it, and if they propose it, if they pass it, it will come into effect later this year. And that's to require large banks to have more capital. Capital is to a bank what an emergency fund is to you. It's their cushion in case things go bad. And after some of the high-profile bank failures that happened earlier this year, they want to forestall any more of that sort of thing. So they're looking at making large banks keep 2% more capital than they have now. In other words, $2 for every $100 of risky assets that the bank owns. And that may not seem like much, but in terms of nominal dollars, it's a lot of money. The banks are generally against this rule. They are saying that it will slow down their availability to lend money. It will make them tighter with credit. It will slow the velocity of money that flows to small businesses and things like that. And of course, that's what the Fed wants. The risk they're taking is that all these things will have their impact at the same time, that the higher interest rates in the economy and the higher unemployment and the lower availability of business credit, all these things will hit at once and push the economy into recession. That's their concern, that's their fear. We won't know till it happens how this turns out, but you need to know that these pressures are coming. So I would suggest that everybody do the things we've been saying to do right along here. Stockpile some cash of your own. Make sure you're in a position to be okay if a recession does in fact hit with any severity. If you lost your job, make sure you're in a position to keep being able to pay your bills. Be careful about discretionary spending that's not necessary. Definitely don't run up any debts that will be ongoing because the Fed's actions will have an impact on that. And it's not just July. The smart money on Wall Street is suggesting there may be 2 more in September and November rate hikes before the Fed levels rates out, and they will stay high and level until inflation either hits the target they're looking for or the recession gets so bad they have to reverse. So keep that in mind and be ready for that kind of action from the Federal Reserve. It is coming based on the inflation report that we get on July 12th. We're going to stop for a moment and pay some bills of our own, but when we come back, we're going to talk about some things that you may not have been hearing much about, like the stock market rally. There has been one going on in this country. Year-to-date, markets are up. We'll talk about how much and whether or not most people are benefiting from it, and how robust it is, and where else people are making money besides the U.S. stock market. All that's coming up. So stay tuned, and we'll look forward to talking to you on the other side.
Do you want to make a bold statement? Do you want to stand out in the room? Check in with us before you step out. On-demand designs and timeless statement pieces are here to channel your impeccable style from this season to the next. You can have it all, so go get it and be confident when you do. Jewels on Demand, inspiring elegance and confidence.
Hello and welcome back. We're moving now, pivoting into what's been going on in the stock market. You know, sometimes it's hard to see the trends because what happens, you watch the news and every day they tell you, the Dow ended here, the S&P ended here, the NASDAQ ended here, here's the numbers, that was up from yesterday or that was down from yesterday. So what tends to stick in our minds is how today's closing numbers compared to yesterday's closing numbers. What's harder to see is what the trends have been over time. And certainly since the pandemic, we have seen a lot of sideways and downward motion in the stock markets, so much so that you may not have noticed that the markets have been climbing quite a bit recently. The S&P 500, which is the generally called the broad market index. It represents the 500 largest market cap companies that trade on the American exchanges. The S&P 500 is up year to date 15.75% as of the day I record this, and that's pretty significant considering that the long-term average annual return of the markets is somewhere in the 10% range gross. That's pre-tax, before you account for tax and inflation. It's not a real return. Real returns are closer to 7, but it's up 15.7% year to date through July. And while we were all licking our wounds from the market declines of 2022, we may not have noticed the acceleration, the rise this year. A couple of things I think are worth saying. This is yet another example of the fact that we cannot time the markets. I, for one, don't see a whole lot of reasons for this recent rally, and in fact, it's what I would call a very thin rally. What do I mean by thin? Well, of the 500 stocks in the S&P 500, there are about 12 that are largely responsible for all of this increase in the index's value. So it's not what we call a wide rally with most of the stocks in the index rising. Rather, it's a few of the most heavily weighted index stocks in the index rising and driving the whole index up. So it's kind of a narrow rally, and that implies it's maybe a little fragile. If those particular companies stumble onto harder times, and the Fed's higher interest rates might help with that, then the index itself might reverse direction again and start heading down. The point is, we never know when, and we never know how much. So the best thing you can do as an investor is to invest regularly, regardless of what's happening day in and day out. When you invest a fixed sum of money in the market, like you do in your 401k, because money comes out every pay period and goes into your 401k, and that happens whether the markets are up or the markets are down that day, that week, that month, or that quarter. You're putting in a fixed dollar amount. When share prices are higher, you are buying fewer shares with that fixed dollar amount. And when share prices are lower, you are buying more shares with that fixed dollar amount. In other words, on average, you are buying low. It lowers your average cost of acquisition per share, and that's exactly what you want to do. You want to buy low so that you can later sell high. But it is exactly the opposite of what most people do when they're not forced into dollar cost averaging by something like a 401k. If they're investing discretionary dollars in a taxable investment account, then typically they fall victim to the temptation to time the markets. And so when the market craters like it did in 2022, they decide this isn't a good time to be in, and they stop investing. And then when the market goes the other direction, it takes them a while to notice. And by the time they're convinced things are going well again, they've already missed most of the rally. For instance, the 15% that the S&P 500 is up this year, many people will not have participated in any of that because they were sitting out for fear of more of what we've got in 2022. Same thing happened in the Great Recession of 2008. The market began to fall in 2007. It fell throughout 2008, and the market bottomed out in March of 2009. In March of 2009, it turned around and began what would eventually be a very long bull market. But most people were still withdrawing funds from the market. Net flows from mutual funds were negative. In other words, more money came out of mutual funds than went into them for an entire year following March of 2009, meaning they missed a rally that in that year produced better than 20% returns. So the moral of the story is, don't be that guy trying to time the market. If you understand that you need to be invested, then invest. Invest consistently. Don't pretend that you or anybody else has a crystal ball, and know that over the long term, the averages should take care of you. Now, what about the person who says, but I don't have the long term? I'm 64 years old. I plan to retire in exactly 1 year. What I have is pretty much what I have. To that person, I would say, remember this. Your investing doesn't end on the day you retire, because the goal of your investing is to give you sufficient income between retirement date and the day you check out, the day you die. That might be 10, 20, 30 years down the road. Do you know that a married couple, each age 65, if they retire at 65 in good health, there is a 40% chance that at least one of them will live to be 90. Meaning when you retire, 65, 66, 67, depending on your age, these days most people at 67 want to be fully eligible for their full Social Security benefit. But it's not a stretch for them to have to pay for 25 years of retirement after that. So your investing doesn't end because retirement day has hit. And so that's one thing to keep in mind. The second thing to keep in mind is there are ways to invest where you can give yourself some access to the unparalleled upside of the markets without exposing yourself to the most catastrophic of the downsides. Now, this is not a specific investment recommendation, because I don't know you personally or what your personal financial situation is. But let me talk to you about some broad categories and some broad possibilities, things you will want to discuss with an advisor to see if they can be of benefit to you. One of those things is called, in broad terms, a buffered ETF. It's an exchange-traded fund that exposes you to an index like the S&P or the Dow or the NASDAQ, and it has buffering built into it that can insulate you against a certain percentage of the market's decline if they happen. So you might buy a buffered ETF that says if the market falls 5, 10, 15, 20%, that won't impact you. I've seen buffer ranges up to 30%. Now, if the market falls more than the buffer range, then you would be subject to the excess loss potential. But it's a rare year when markets fall more than what a typical bear market does. 20, 25% is often typical for a bear market. 30% has happened. More has happened, but it's an extraordinarily rare thing. If you were insulated from the first 10 or 20 or more percent of market decline possibilities, that might be something to induce you to continue to stay in the markets and continue to invest in the markets so that you can have a good percentage of the upside potential. The other thing is products such as, say, indexed annuities that give you, again, a portion of the up without exposing you to any of the down. So those are all possibilities. The other thing that I'll mention to you, in terms of negotiating your way through this market, I started with the Fed. I want to end with the Fed. The interest rate environment means that right now adjustable rate mortgages aren't doing a lot for people, and not a lot of people are applying for them, and I really almost never recommend them. In the past, when rates rose, people would typically turn to adjustable rate mortgages because they would have lower rates for a fixed period of time. Could be 5 years, could be as much as 10 years, could be 2 years. It depends on the terms of the particular mortgage. And it would reset at the end of that guaranteed term. And because it was so much lower than the current rate on a fixed mortgage, people would buy them gambling that when it resets, rates in the economy will be lower and I will reset lower. In this particular go-round, it doesn't look like that. The rates for adjustable rate mortgages right now are averaging 6.7 to 7%, meaning they're the same as 30-year fixed. And so to take the risk that rates might be actually higher later by buying an adjustable rate mortgage, getting an adjustable rate mortgage now, isn't worthwhile in most people's eyes. And I always say to people, if you're going to go the route, if the spread gets better again, so that there is a significant discount from the adjustable rate mortgage compared to the fixed rate, then make sure you're in a position to keep paying in a worst case scenario. If rates reset and they're higher and you can't refinance, if you lose your job, will you be able to pay the mortgage when the adjustable rate mortgage has gone to its highest possible number? If the answer to that is no, I'd say stick with the fixed, wait for rates to come down. If you're not an owner now, don't necessarily be in a rush to be. Rates will come down at some point, but don't get yourself into the ARM trap. So I think of this as disarmament, because the ARMs are sort of falling off the table right now for most people. Hey, we've run through another essentially half-hour show. I've got 2 minutes on the other side. I'll wrap this up, put a bow on it, and give you some information you're going to want to have. So stay tuned, and we'll close things out in just a minute.
The Well Jamaican Restaurant, located at 55 Mazio Drive in Randolph, Mass., where good food and fellowship meet daily. Check out our variety of fresh and tasty entrees and sides from our menu or the website, thewellja.com, like our jerk chicken, oxtails and rice, seafood, desserts, and more. With our drinks and juices made fresh daily, you have the option to dine in or take out. We can also cater your special event, or you can book our private dining room and let us host your special event. At the Well Jamaican Restaurant, we pride ourselves on providing superior quality food and beverages, and of course, great customer service. Next time you're in the mood for Jamaican cuisine, meet us at the Well Jamaican Restaurant. Become part of the family. Connect with us on Facebook and Instagram. The Well, where good food and fellowship meet daily.
Let me wrap it up with a few thoughts for you. Number one, when you hear financial news, take a minute and ask the internet, if nothing else, what this news means. So you hear the Fed raises 25 basis points. Google when the Fed raises rates and get some of these implications so you become more familiar with what the news means as opposed to simply what the news is. The second tip I want to give you is to keep in mind the fact that the behaviors that will get you from where you are to where you want to be don't change with the daily news. You need to save, you need to invest, you need to be consistent, you need to buy low so that you can sell high. These things don't change. Don't let the news of the day panic you into forgetting that. Remember that somebody is always making money somewhere. Even if it's here. We talked about the rally in U.S. stocks. People have been making money this year. Have you, or were you on the sidelines? Do you want to get off the sidelines and back into the markets? We didn't talk about it today, but markets overseas often do well when ours does not. The Japanese stock market's up 25% year to date. So there's always options. There's always things you can do. And I encourage you, give us a call or drop us an email and discuss what options might be available to you. You can always reach me, 978-775-5435. The number's on your screen. Or drop me an email at john.harrison@aspirefa.com. Having an introductory phone call is always free. And if you'd just like to ask some questions, how does some of this stuff that you talk about apply to me? I would be happy to speak with you. So that's going to wrap up another episode. Come back to this same, wherever you're watching us now, and look for the next episode. And remember, stay encouraged. You can get from where you are to where you're going. All you need is a little direction for the journey. And that's the bottom line.